All right. Hello, everyone. Welcome back to the research challenge. This time we are here for the Asia Pacific finals. My name is Samantha Bray, and I manage the research challenge at CFA Institute, and I am based in our Charlottesville office. And yes, it is the middle of the night here, so bear with me. Um, so things are really heating up. The four teams competing today have already achieved significant successes, winning their local competition, competing against their neighboring universities, went on to succeed in the sub-regional round, and earlier this week, it came out of the semifinal round as winners. So they've offered superb presentations and are surviving a lengthy Q&A session from our panels of experts. We really are seeing the brightest and the best finance students from right across the Asia Pacific region. So congratulations to you all. The hard work you all have put in is directly relevant to the content of CFA program itself. And we hope that you will consider deepening and widening your knowledge by taking the next logical step, which would be registering for the CFA program and pursuing your charter, joining 200,000 other successful CFA Institute members, leading the investment profession in the financial markets around the world. You are all winners by getting this far in the competition, and we really want to recognize that. So we are going to be offering every participant today in the Asia Pacific Regional Final a CFA program scholarship discount. We will have more details about that to share come May after the global final. So stay tuned. I would like to thank our volunteer panel of judges. You guys have given your time a considerable commitment to support this development of our future investment professionals from right across this region. Our judges are firm, focused, and fair, and we are very grateful for all of them. On to the details. Everyone is currently in the main session room. It's very similar to the semifinals. We will move you all to your individual team rooms, and we will have a presentation room. We do ask that you stay connected in your presentation or in your holding room until it's your turn to present in the presentation room. After your team is presented, you're welcome to disconnect and rejoin for the advancement announcement if you would like. Only the timekeeper, teams, and judges should have sound and video enabled at any time. We will ask the judges to turn their cameras off during the presentations and then back on for Q&A. All other attendees should remain muted with your video off. A 1-minute warning will be provided for the presentations, but not for the Q&A period. And as a reminder, the Q&A period for the regional final round will be up to 15 minutes. For the best viewing experience, we suggest hiding non-video feeds, but there are many options, so take your time and figure out which view looks best for you. The teams competing today are the University of Hong Kong, representing CFA Society Hong Kong, University of Auckland, representing CFA Society New Zealand, University of Finance and Economics, representing Mongolian Society of Financial Analysts, and University of Sydney, representing CFA Society Australia. The judges today will be Mohammed Shoaib, CFA, Yu Liao, CFA, Ritwik Baswinga, CFA, Gabriela Clivio, CFA, and Steve Sun, CFA. Adrian will be our timekeeper. At this time, we will go ahead and start moving the judges, guests, and the first presenting room or team to the presentation room. Everyone else will be moved to their individual holding rooms. It may take a couple minutes, but we wish you all the best of luck.
Shenzhou may not be a household name, but chances are you are wearing something they make. As the manufacturer behind giants like Nike and Adidas, Shenzhou quietly dominates the apparel supply chain. Now the question is, how could we capture its growth in the fast-changing and challenging market? Greetings everyone, we are Team Hong Kong U. I'm Adrian, and these are my teammates Taeyuk, Kelvin, Huey, and Sharon. Today we will set to propose a buy recommendation on Shenzhou. So let's get started. We view Shenzhou as the leader in the OEM market with growth drivers yet to be priced in. We expect Shenzhou to benefit from bottoming out sports apparel sales, overseas expansion, and higher sportswear product mix. And our estimates showed a higher market share gain, cost reduction, and greater margins compared to consensus. In terms of valuation, we believe Shenzhou is overpenalized by the market on Trump tariff impacts, leading to our buy recommendation with 28% upside. I'll now pass the time to Taeyuk to dive into the business.
Shenzhou International is one of the world's largest vertically integrated knitwear manufacturers and a leading exporter of garment products, including sportswear, casual wear, and innerwear. It supplies global brands such as Nike, Adidas, and Uniqlo, solidifying its position as China's representative in the global apparel industry. It operates a hybrid business model, combining OEM for garment production and ODM for fabric production, which provides distinct advantages, including value chain control, agility and market responsiveness, and stronger client relationships due to the end-to-end solutions that make Shenzhou an indispensable partner. 80% of its revenue comes from core clients, with Uniqlo as the largest contributor at 28%, followed by Nike, Adidas, and Puma. It sells primarily sportswear with a growing shift towards casual wear and innerwear to diversify revenue streams. And China remains its largest market with balanced exposure across Europe, the US, and Japan. The global sportswear manufacturing industry is constantly evolving, particularly with rising US-China tensions that is accelerating production relocation to avoid tariffs and maintain export volumes. Growth in the athleisure market that is projected to benefit Shenzhou's key clients, as well as Shenzhou itself with greater production demand. Digitalization and automation to boost margins and reduce costs. And finally, the increasing demand for eco-friendly production. Shenzhou competes in sportswear and textile innovation. However, it maintains a competitive edge in comparison to its peers. Firstly, with a vertically integrated value chain. Secondly, with aggressive overseas expansion. And finally, with a continued investment into digital infrastructure and automation. The most important would be the vertically integrated value chain. By controlling the entire production process, it's able to lower costs, provide superior quality control, offer faster turnaround, and improve profitability with better pricing power and inventory optimization. Here's our analysis of Shenzhou's 2025 year-to-date share price performance compared to its peers. After carefully considering the effects of US tariffs, we've noted a significant over-penalization in Shenzhou's stock value. Its recent share price drop, the largest among its peers, stands out, especially since Shenzhou has least US exposure in the group. Now we will introduce our investment thesis for Shenzhou International.
Thanks, Teok. Our first investment thesis is Shenzhou can be a major beneficiary from bottoming out sports apparel sales. In the fourth quarter of 2024, the inventory level among top Shenzhou clients has undergone a positive trend. And Shenzhou top-line growth tends to correlate with the growth of its clients' cost of goods sold. And therefore, we expect a sustained top-line growth for Shenzhou given strong client sales and restocking activities. Next, I will deep dive into the three key customers. The graph shows that there's a high correlation between Shenzhou and Nike, since Nike is the largest customers. And we anticipate there's a short-term headwind due to excess inventory and also a challenging FX environment. However, the management shift should serve as a long-term tailwind, focusing on premium pricing and aggressive marketing strategies. On the other hand, we are optimistic about both Puma and Adidas prospects as they are experiencing high double-digit revenue growth and improving margin in the latest quarter. Moving on to the second thesis. Shenzhou can enjoy a lower production cost through overseas expansion. We observe that it's an industry trend to move the production overseas, like Maglot and Eclipse have shifted to Indonesia. And Shenzhou has successfully shifted its production from China to Cambodia and Vietnam. And next, since Shenzhou operates in a labor-intensive industry, where wages and salary accounted for a quarter of its revenue, and we see overseas expansion can greatly improve its profitability, given reduced salary expenses and alleviated geopolitical risk. And now I will pass the time to Huey to talk about the third thesis.
Thanks, Kelvin. Our third thesis is margin expansion from a higher sportswear product mix. We believe Shenzhou's robust R&D capability will continue to attract new partnerships, and this is evident as it entered into Lululemon supply chain in 2022. Since then, our estimates suggest that Shenzhou's supplier share had at least tripled, making it now the largest Tier 1 supplier of Lululemon. In the near term, we believe Shenzhou's importance in Lululemon supply chain will continue to increase. On the other hand, Shenzhou is deemed to ride on the emergence of domestic brands in the Chinese sportswear sector due to its unique value proposition. From this graph here, we can see Anta leading all these Chinese brand names growing at double-digit CAGRs in the past 5 years. Going forward, we see that the domestic demand will remain strong, and we anticipate domestic clients to see a 12.3% revenue CAGR, thus increasing their revenue contribution to Shenzhou to 18% by 2029. Moving on to Shenzhou's ESG performance, we see that it is largely in line with its peers. However, it is lagging behind in the environmental aspect. Its greenhouse gas intensity remains above its peers despite a reducing trend. But we are positive that Shenzhou will be able to meet its 42% reduction target by 2030. For corporate governance, Shenzhou has a strong and effective management team. Its ratio of director remuneration to profit is below average. Its gender diversity and independence ratio of the board also outshines its peers. Shenzhou has not yet disclosed any KPIs that link executive pay to its ESG performance, but overall, we still have a strong confidence in its management team. To conclude, we determined that Shenzhou does not materially lag behind its peers in any category, and so this does not create any concerns for its core business. Now, I will pass the time to Adrian to talk about the valuation.
Thanks, Huey. I will now move on to valuation and projections. We expect sustainable revenue growth from core clients and increasing domestic demand, with 11% revenue CAGR from 24 to 29, driven by sales recovery of core clients and strong growth in domestic clients. Regarding the margins, we expect the sportswear mix to be higher than consensus, brought by a shift in product mix, driving up ASP and also margins. Regarding valuation, we adopted a blended valuation approach to value Shenzhou. For our discounted cash flow model, we made projections on 5-year free cash flow, and under our WACC assumption of 10%, our target price of $64 is derived. We also performed relative valuation and selected 2 different peer groups, namely sportswear and casual wear, with different weightings to better estimate the value of Shenzhou. We could see Shenzhou actually trading far below its peers in the sportswear industry, and hence we derive a target forward PE of 13 times and a target forward EV/EBITDA multiple of 8.8 times. Overall speaking, we balance various metrics in valuation, and here are the key assumptions for our estimates. As a result, we derive a target price of $60.2 with 28.4% upside on closing price this Wednesday. I'll now pass the time to Sharon for the risks and mitigations.
Thanks, Adrian. Finally, we move on to talk about the risk and mitigations. In terms of market risk, it is foreseeable the market is going through a recession. A lower demand in knitwear products may affect Shenzhou sales core clients, in turn harming Shenzhou's orders and margins. Moreover, the recent 145% US tariffs on China and other reciprocal tariffs that are going to be imposed on other production-based countries may further worsen Shenzhou's cost competitiveness, thus hindering Shenzhou's revenue target. In terms of firm risk, approximately 80% sales are derived from its top 4 clients. Fluctuations along with tariffs from the top 4 clients could have a huge impact on Shenzhou sales. Lastly, changes in local regulations in Vietnam, Cambodia, and Indonesia, such as a reduction in Vietnam tax premium, could also hinder the capacity expansion plans and incur high costs for Shenzhou. However, with relevant mitigants, we believe the risk could be mitigated. All in all speaking, Shenzhou has tailored its assets and is ready to stitch its mark on the market. Looking forward with a fast recap with the investment thesis of today, our team would suggest a buy rating with a potential upside of 28.4%. Thank you, and we will now open the floor to questions.
Thank you. Judges, you may now turn on your video. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Hi, thank you for your presentation. Can you tell us why do you think that the sports apparel sales is bottoming out?
Thank you for your questions. So, moving on to, we think for page 61. Sorry. Yeah, 43. Because in the past, we saw that in this year, 2024, we saw there's a huge drop in the inventory turnover days, especially for Uniqlo and Lululemon. And we also observed that moving on to like three slides, three slides. And Adidas and Puma are experiencing high double-digit growth with improving gross profit margin. And also, Uniqlo yesterday have upgraded their guidance, especially regarding their operating margin and net margin. And therefore, we see that there's a huge demand for the sports apparels. Therefore, we expect there's a gradual restocking activity after 2023.
Okay, thank you.
I
I have a question. I'm
I
sorry.
have a question. I'm sorry. I have a question. You said that in your valuation model, in the discounted cash flow, you choose a 5-year period. Why did you choose a 5-year period?
Thank you for your question because I think this industry is a very cyclical industry, and we observe there's like a major trend in the past years, including like 2018 and the COVID trends, and then we observe that the core clients of these customers are Nike, Puma, and Adidas those, and they actually have a restocking cycle and also a sales cycle in around 5 years. So I think making like a 5-year projection in the free cash flow could be a realistic assumption for our expectations.
So at the end, you combine these 5 years with a terminal growth rate of how much?
Yes, here is our discounted cash flow model. Actually, we first calculated the 5-year free cash flows, but this time we did not use a terminal growth rate because for the terminal growth rate, it may be quite unstable because this industry is very cyclical, and also there are like a lot of unexpected or very hard to measure impacts. So we actually used an exit multiple based on the target EV/EBITDA ratios for the peers, because we observe from the peers that Shenzhou is currently fairly lower than its peers, but the gap is actually closing between its peers like Eclat and also Mechalot. So it's a very reasonable assumption to assume that it is closing its gap to its peers, and assume an EV/EBITDA multiple for exit to calculate the terminal value, and combined with the 5-year free cash flows, we will arrive with a target price of $64.
Okay.
So I have three very challenging questions. So number one, and my understanding of Shenzhou, this stock is the problem is not really Shenzhou, it's its customers. Nike was not doing very well. And your thesis is that we'll move into domestic brand. So what effort has Shenzhou taken in the past to demonstrate it has the ability to move into domestic brand?
Thank you for your question. I think, first of all, the Chinese sportswear subsector is a very niche subsector that is still seeing growth despite all this trend of consumption weakening, and also the consumption down trading observations in China right now. So what we see is that this Chinese sportswear subsector is growing fast is because the sportswear penetration rate of China is actually remained very low as compared to other developed countries. So as you can see on the graph on the left-hand side, the sportswear penetration rate is only at around 15%, but then that's of the other developed countries is around 21% to 36% in the US. So this offers a huge white space. And I also believe that as this sector is also a policy favored sector, which the government has policies rolled out like the Healthy China 2030, also the 5-year development plan that aims to push this subsector to grow to 600 billion yuan by this year. So I think the domestic brands actually see the opportunity here, and they are trying to capturing it. And besides brands like Anta, Li-Ling, and also some foreign brands also see the opportunities here. So one example would be Lululemon. Like they have been trying to grow their revenue in China rapidly. As we can see here, over the past 5 years, the 24% CAGR in Lululemon is actually mainly driven by the growth in China. So we do believe that Shenzhou, as a Chinese manufacturing partner, offers a really good competitiveness and attractiveness to the domestic brand names and also foreign names as they want to grow their business in China. As to the question why they choose Shenzhou, besides that they are strategically located in China, and other reasons also attributed to their R&D capabilities. And as we go to appendix slide of for this appendix slide B9, we can see that Shenzhou actually has a huge innovation capabilities, which they are not only just an OEM, but they are also an ODM, which has the capabilities to innovate new fabrics. So for example, you can see that on the table on the left-hand side, they actually cooperated with major clients like Uniqlo and Nike in their fabric innovation. So this is something that the other OEM cannot offer. And because of this, this is also another major reason why Uniqlo and Nike have to be so sticky with Shenzhou as well. So I hope this answers your question. Thank you.
Very good. And the second question is also very challenging. Shenzhou's management is very old. It's all near retirement age. So what's the succession plan for the management?
Thank you for your question. I think that I do agree that the management team is the average age is actually older than their peers, and we can see that their entrenchment year is actually come at 12.4 years, which is higher than their peers a lot. Because the peers might only be at a range of 5 to 10 years, but not over 10 years. And we see that actually we do have a huge confidence in the management team, since all of them have extensive expertise in the fabric side and textiles industry. And we see that there is not yet any new succession plan as of now. And we believe that in the near term, the team will still continue, and they might try to seek for some new blood to enter the management team as well. But there is not yet a fixed succession plan as of now.
Okay, a last question. I require a very short answer. So 30% upside is very significant. So if I'm an investor, give me one reason I should buy this stock today.
Okay. Thank you for your question. I think the major reason that you should buy the stock today is that it's overpenalized by the market, supported by its very strong fundamentals compared to its peers. Its peers drop around 10 to 20%, but Shenzhou dropped over 30% despite its very low US exposure. So I think Shenzhou, given its very strong margins, innovative capabilities, and also different fundamentals, Shenzhou is a buy.
Great. Thank you very much.
All right, team. First things first, clear narrative, good flow in your thesis structure. I just have a couple of questions. First, if my calculations are right, wage costs account for about 25%, 28% of Shenzhou's revenue. Now, given that, and with the fact that wage costs are rising substantially in Vietnam and Cambodia, and there are potential regulatory shifts in Indonesia. How do you reconcile the long-term sustainability of margin expansion?
Thank you for your question. So we see that there's moving to slide in the second investment thesis. We actually found that next slide. There's the wage in Vietnam and Cambodia is 33% to 39% lower than the same wages in China. And even though there's an adjustment in the regulation, which may cause some increase in the the wages and salaries, which we still believe that is substantially lower than China, and therefore it will not greatly affects its profitability for Shenzhou.
Yes, and for another add-on, I think our major margin expansion thesis is not only driven by the cost reduction, it is also driven by our shift in the product mix sportswear. For example, here, our consensus of sportswear mix is actually higher than consensus, our estimates, and this actually leads to a higher profit margin because the management also have the guidance that the sportswear profit margins is higher than the other products, including casual wear and also other products. And because we are driven by a huge domestic growth of sportswear products, including Anta and Li-Ning, and also sportswear products like Lululemon, we are also gaining a lot of market share. And besides, actually, for the old core clients, although they are having a downturn, they are also we can also see an increase in market share for those companies. For example, like Nike and Adidas, they have reduced number of suppliers. So actually, this leads to an improvement in profit margin brought by an overall big shift in the product mix, and also supplemented by the cost reduction in the production in labor.
Yes, to add on, I think it is also stated in the annual report that Shenzhou is adding supporting facilities for auxiliary processes and to outsource labor to reduce labor costs while maintaining the working populations in the factories to maintain a better profit margin.
Fantastic. And finally, I see that almost 75-80% of Shenzhou's revenue comes from four major clients. And given that you've only taken a WAC of 10%, give or take, how do you incorporate customer concentration risk into your valuation and terminal growth assumptions?
Thank you for a question. And here is our revenue forecast for our customer. And then the major rationale for our revenue core client forecast is we first lay out the potential cost of goods sold, the expected cost of goods sold of the clients, and then calculate our market share per brand, and then also make projections. And we can realize like Lululemon, its market share is actually getting higher and higher. For example, it's 1.7 in 2022, but it rise around double in 2026 for our expectation. And I think these new customers, because Lululemon at first is not a very new customer. It is a new customer in 2022. But Shenzhou, we can see very strong efforts in trying to expanding its customer network, and not to say the domestic customers are also taking a greater and greater revenue share from around 17% and growing by 1% in 2 to 3 years. So I think Shenzhou has been has tried a lot of effort in expanding its customers while maintaining relationship with its old core customers.
Have you looked at the use of technology? How have they focused on technology to reduce their cost of production? Anything on that?
Here is like thank you for a question. We could see actually Shenzhou is now trying to increase their investments in digital infrastructure to boost their product efficiency, and it has a lot of big upsides. For example, it has like a better inventory management system based on digital infrastructure, and also they are also doing digitalization on like improving their efficiency of their factories. Although these impacts are not very direct into like maybe it's the direct gain in revenue or direct reduction in cost, but I think overall speaking, in long term, it could help drive the smoothness of Shenzhou's business, and also improve the inventory turnover rate, and also improve the overall business.
And
Also
just,
adding,
yeah,
sorry.
just to quickly add on to that is that Shenzhou is mainly using AI to incorporate into their R&D lab. Instead of like incorporating into their production side, they're mainly using AI to really enhance their R&D capabilities.
And finally, what do you think in terms of ESG and the trend that is in place of reducing consumption or reusing the trend that we reuse clothing and apparel?
Thank you for your question. So, as we assess the ESG performance of this company, we do think that the E side and the S side are the major concerns of this company.
That is
And
time. Thank you, University of Hong Kong. At this time, the judges will take a few moments to collect their thoughts before the next university is brought in. Thank you again.
Thank you.
Thank you.
thank you.
Thank you very much.
Thank you. Let's get this.
Righty,
Yes.
judges, could you please turn off your video for the presentation? Thank you. Okay, welcome, University of Auckland. I see you have launched your presentation. Feel free to click through, make sure everything is working properly. We ask that you remain muted unless you are speaking. Time will begin as soon as a member of your team speaks the first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Feel free to begin whenever you're ready.
Thank you. Hello and kia ora. We're Team Auckland University Equity Research, and today we will be presenting why we think Sky City is a buy. When you're looking to take this bet, remember, the house always wins.
Founded in 1996, Sky City is New Zealand's largest tourism and entertainment company. With the flagship Sky Tower standing 328 meters tall, it draws over 10 million visitors to their properties each year. The Sky City ecosystem offers services ranging from gambling, 5-star hotels, and casinos. The Sky City operates most prominently in New Zealand, Australia, and an offshore online gambling service in Malta.
Taking a wider look across the gaming industry, we can see that there is a compound annual growth rate of around 2 and 4% within the casino industry between both New Zealand and Australia. This, combined with strong per-user spend metrics, is reflected in the casino expenditure recovery in both countries. The competitive landscape of Sky City is split between casino operators and non-casino operators due to the monopolistic nature of the market. A casino operator is someone who owns or runs a casino, while a non-casino operator is just another place that players can go to gamble. This could include a sports betting platform, a pub or a club with an electronic gaming machine, or a lottery provider. Taking a look at market share, Sky City has a whopping 77% within the New Zealand land-based casino market. So this raises the question, is the market folding on a winning hand? The market is priced in short-term fears of regulatory uncertainty, a pause in dividends, and macroeconomic pressures. The Sky City has an ace up its sleeve. They're overcoming regulatory hurdles with the implementation of mandatory carded play along with online gaming regulations. Dividends are expected to be back on the table as per management guidelines, and a rebound is underway from the macro side. This cements our buy recommendation. With a target price of $1.62 per share, reflecting a 28% upside, now is the time to go all in on Sky City.
Our first investment thesis covers Sky City's digital expansion and market monopoly. Sky City's brand is synonymous with Auckland and with New Zealand, with the iconic Sky Tower being the central component of the city's skyline. This strong brand presence is further reinforced by their exclusive casino licenses, securing monopoly positions in key markets like Auckland and Adelaide. When comparing EBITDA margins, Sky City demonstrates solid performance, with margins significantly higher than key competitors. Coming in at 4 times higher than their direct industry comparable, Star Entertainment Group, the strength and resilience of their operations is clear. Their unique entertainment suite with restaurants, bars, hotels, and gambling, all within the same block, contributes to this robust offering and diversified revenue streams. Looking ahead, Sky City's expansion into the online gambling market represents a key growth driver, with the potential for better margins and better scalability. With the online market estimated to exceed $700 million by early 2026, we expect Sky City to claim $100 million of this market.
Our second thesis is how Sky City is turning compliance into a competitive strategy. Sky City is currently undergoing the implementation of mandatory carded play rules, which initially seems like a setback, with an expected $100 million hit to their revenues. But they are positioning themselves to use MCP as a strategic advantage. Firstly, the shift in consumer behavior due to player tracking allows them to gather more data-driven insights. This improves how they track customers and enhances responsible gaming and compliance. It means Sky City will be better equipped to comply with regulations like anti-money laundering rules, and in the future, be more transparent and secure. But there's more to this. Sky City can turn this into a deeper relationship with its customers. With MCP, they can build loyalty through reward programs, cross-sell services, and strengthen overall customer engagement. This not only increases their revenues, but also creates a competitive moat around the Sky City ecosystem consisting of hotels and restaurants.
And finally, thesis 3. There has been a formalization within the industry, and there are 3 main drivers behind this: a market consolidation, a crackdown from regulators, and a shift in consumer preferences. The consolidation is due to the sinking lid policy put in place by New Zealand regulators. This essentially caps the number of electronic gaming machines outside of casinos to its current level and does not allow for any license transfers. This has an artificial decrease by around 13%. The regulator has been cracking down across the gaming industry, but there has been a specific focus on the smaller players, as indicated by some of these headlines. There is also a social and political side to this, those from poorer, lower socioeconomic backgrounds being disproportionately affected by these smaller players. And finally, a shift in consumer preferences. Gamblers are preferring to gamble in a safe, regulated environment over the back of a pub or a club, as it might have done previously?
We recognise 4 main downside risks for SkyCity, but there's one we deem most significant, which is the risk of losing their South Australian casino licence. Now, there is currently an investigation into SkyCity's suitability to hold this licence, but we think this poses a bigger threat to their reputation rather than their financials. However, the likelihood of them losing this licence is low, given their proactive steps to enhance compliance and historical instances of similar investigations like with Star Entertainment Group.
SkyCity are making solid strides in sustainability, with key environmental goals that align with their long-term objectives. SkyCity aims to reduce Scope 1 and 2 emissions by 73% by 2050, having already achieved a reduction of 20.6% since 2015. SkyCity has also set a zero waste target, supported by its partnership with Remondis in Adelaide, converting dry general waste into biofuel. On the social side, SkyCity leads with responsible gaming initiatives like self-exclusion and host responsibility programs.
SkyCity is getting ahead of the regulatory pressures with the pending implementation of mandatory carded play. While anticipated to bring an initial financial hit, the benefits of the use of this technology will bring regulatory protection for years to come, offering increased visibility of problematic play and at-risk gamblers. It also decreases the risk of AML violations, enhancing the traceability of these gambling transactions. On the governance side, SkyCity has a great path forward with a new CEO and CFO at the helm, bringing with them clear strategy and a wealth of experience. The board of directors also offers this wealth of experience with areas of expertise spanning fields crucial for the long-term success of SkyCity.
Taking a look at SkyCity's finances, it is clear that they are taking a more conservative approach to capital management as a result of the previously high capital expenditure due to financing the New Zealand Convention Centre. SkyCity are prioritising paying down their debt as well as refinancing shorter-term debt. As a result of this more conservative approach, they have announced a suspension of dividends for fiscal year 2025. Taking a look at their earnings shows strong gross profit margins, with overall margins rebounding back from the COVID-19 pandemic.
We valued SkyCity using a blended approach consisting of a bottoms-up discounted cash flow model weighted at 40% and relative valuation and some of the parts at 30%. This arrives at a share price target of $1.62.
For relative valuation, we selected 7 comparable companies to SkyCity. We then weighted them according to how closely comparable the company was to SkyCity. For example, a company like Skyline was allocated a heavy weighting of 30% due to Skyline's revenue streams being closely correlated with New Zealand tourism numbers, just like that of SkyCity's. A company like Genting Malaysia, on the other hand, was allocated a smaller weighting of 5% due to Genting Malaysia being in a different geographical market to SkyCity and therefore less comparable. The 2 multiples we used were enterprise value to forward EBITDA and forward PE ratio. Using these 2 multiples arrived at 2 implied share prices, which were then averaged to arrive at $1.29.
From narratives to numbers, our discounted cash flow model is based on the main thesis and risk that we've discussed. The main drivers behind these cash flows is the growth in online gaming, far lower capex spend as SkyCity comes out of a decade-long capital-intensive cycle, and investments to have a stronger compliance framework. Using a 7.5% cost of capital and a 2% terminal growth rate, our DCF model suggests a 40% upside for SkyCity. Our scenario and sensitivity analysis, backed up by a Monte Carlo simulation, shows the asymmetric nature of this gamble, as the upside is far greater, even with our modest estimates.
SkyCity's sum of the parts valuation arrives at a firm value of circa $2 billion, and this is derived from 3 key segments: the physical land-based casinos, hotels and hospitality, and the online gaming business. For our valuation, we used a DCF-led approach for the physical mature casino business, looked at comparable companies for hotels and hospitality, and used preceding acquisition multiples to value the online gaming segment. All of this arrives at an implied share price of $1.73 for our sum of the parts valuation.
We've covered the key drivers behind SkyCity's success so far, as well as opportunities for growth into the future. And I want you to remember, when the chips are on the table, the house always wins. Thank you so much for your time.
Thank you.
Thank you.
Thank you. Judges, you may now turn on your video. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
I have two questions. The first one is, why did you choose a sum of the part valuation as the valuation tool for the company? And the second one would be, aren't you afraid of the fact that from like a negative screening, this type of company may be excluded from the radar of many investors?
I think I can take this question in terms of the sum of the parts, and I pass it on to my colleague Aryan on the ETFs. So if we can turn on to the sum of the parts valuation slide and the valuation scenario overview. Valuation overview. Yep. When we looked at this, the sum of the parts was mainly in terms of SkyCity having three differentiated businesses, all of them in different nascent stages. The land-based casino is the most mature one. This is mainly in terms of where we use the DCF approach. Hospitality encompasses all of the things such as hospitality, hotels, restaurants, and all of the NZICC, which is the New Zealand International Convention Centre. So this looks into account for EBITDA and looking at relative companies. And the last part is the online gaming. This business hasn't come out yet, so we're using preceding acquisition multiples to value SkyCity's online gaming business, looking at all of the acquisitions that have happened internationally in the past. So these are three segments that SkyCity operates in. I've looked at that to value the sum of the parts. The main drivers behind the valuation is also the DCF, which is the segment specific, and relative valuation to see how SkyCity fares against peers. Now I'll turn it over to Aryan for the exclusion part.
Thanks for that, Deep. And I really appreciate your question. That's a very good point that many of the industry has taken into account this responsible investment strategy. So one of the key things that we looked at was many funds such as BlackRock and Vanguard, these big fund managers, they look for best-in-class metrics instead of just on an exclusionary basis. So in some industries like gaming or so weapons or tobacco or such, they look for the best-in-class providers rather than a flat exclusion. Another one in the New Zealand market, the local superannuation scheme is called KiwiSaver. One of these types of funds is called a default KiwiSaver fund. And so these funds are essentially if an employee has decided not to allocate a fund, the employer puts the money into this fund on their behalf. So these are heavily monitored by the local conduct regulator, and they are required to maintain a responsible investment policy as part of this on an annual review basis. One of these funds, Booster, they hold SkyCity in the New Zealand ESG core shares, showing a true example of this best-in-class policy. And the final point to that is they're also a homegrown leader in tourism, entertainment, and hospitality. They're not only a gaming business.
Okay.
Thanks, team. While I think that using some of the parts valuation and your discounting of the online segment risk is intelligent and fairly well done, I'm a bit unsure on the consistency and comparability across segments because you've used DCF for the land-based casino business, multiples for hospitality, and for online gaming, you've used, I think, revenue multiples, and for hospitality was EBITDA. So I'm just a bit unsure about the consistency across evaluation. But coming to your WACC, right, that you've taken for your DCF, you've taken a 7.23% WACC, right? That's what I saw, I think. Yeah. Now, given SkyCity's credit rating of BBB and a relatively high debt to capital ratio, do you factor potential future downgrades or refinancing risks into your cost of debt? Because I see cost of debt to be quite low over here.
Yeah, absolutely. So Deep can cover the debt overview of SkyCity, and I can cover the transition matrices that we've looked into.
And if we just look at the debt maturity profile, this is really showing how SkyCity has built investor confidence. Before this, SkyCity had a debt maturity average of 2 years. This has now been refinanced and has increased to 4.5 years. And as we can see, they have indicated bank facilities, which are there as a buffer for them. So this is really the drawn debt sources of USPP being the main part, which is the private placement market. And then also the New Zealand bond, which is listed on the NZX. So this is the kind of liquidity profile that SkyCity already has in terms of a lot of the confidence from the market. And if I can turn it back to the credit ratings and the transition matrices.
Yeah, thank you. So we took into account with the transition matrices, we looked across both the Australasian market as well as the wider APAC. We looked at S&P and Fitch sort of data for this. So Fitch gave us the APAC sort of overview. S&P gave us both the Australasian as well as just in the credit ratings themselves, gave us a 1 to 10 year weighted average, showing the probability of an upgrade or downgrade. So we factor this in when we're sort of looking at the risk of if they got upgraded or downgraded. And we've reflected that into our sort of bull and bear case models and conducted sensitivity on that.
I have two questions. So number one, in the summer part evaluation, you use kind of revenue multiple for the online gaming business. Have you studied the profit margin of the comparable business? It seems like if using apply this matrix, this will be difficult to compare if the profitability margin is different. Also, the timing of the transaction is also important because this segment is very volatile since I work in gaming business valuation. So just want to understand your thought about this. And also you probably highlight this as a future upside potential driver. So want to understand your thinking behind this valuation method, matrix.
Well, thank you for the question. If we can turn to the sum of the parts online gaming slide. So the preceding acquisition multiple is mainly because the online regulations have not come into the market yet. So this is a forecast for what SkyCity would be achieving. These regulations are not here, so we're expecting $100 million revenue for SkyCity. The breakdown for this would be in terms of what the market would expect from any other international comparisons, and especially marketing spend is curbed. This will not be allowed in New Zealand, where companies cannot have customer acquisition costs. And it's really building on the SkyCity name and the brand value. This is what the cost structure would look like. The main part of this is that we do not have what the EBITDA margins and things like that would be for SkyCity. So we've taken the EV to revenue. On top of this was added an expected value discount, which is 70% in favor of SkyCity getting the license. So we're still expecting that the owner regulations haven't come out yet. So expected a value of 70% in case that SkyCity does not get awarded this. In terms of all the acquiries and the targets, we've looked at international comparables as Australia as a black market where we cannot operate any of the online gaming, and New Zealand is the first time is implementing this for the first time. We've looked at companies from small to larger ranges inside the transaction multiples, and as you can see, this range is quite tight between 2 to 5. And the biggest part is that the bigger companies have a lower valuation multiple, where SkyCity would be valued on this part. We've been very conservative in our estimate, as you can see with our base, bull, and bear case. And getting $100 million revenue would not be something that SkyCity would find difficult. So this is the main part behind why we value it in this way.
Great. Second question. So what's the catalyst? If I want to buy the stock, what's the catalyst in the next 6 months for me to achieve the 30% upside?
I think that's a great question. So we've kind of identified 3 main catalysts that really back up this buy recommendation. The first one being regulatory clarity. It's no secret that SkyCity has had their challenges in the past, but with the implementation of mandatory carded play, this all but eliminates the chance of the past indiscretions reoccurring. As I mentioned in the presentation, decreasing the risk of AML violations by enhancing the traceability of gambling transactions, and the ability for customers to set self-exclusion limits, limits on the amount they want to spend, how long they want to play, and also for SkyCity to monitor that. They can see how long a card's been used at a given machine, and then kind of intercept, and those checks and balances can be at play. Another catalyst is favourable earnings, with the NZICC expected to open soon. They're forecasting an increase of over 500,000 visitors, which really drives that the foot traffic through the SkyCity precinct. And while the NZICC is expected to operate at break even or just above cost, the main purpose of this is to drive people into the SkyCity ecosystem, the restaurants, the bars, the hotels, and obviously the casino as well. And then finally, online gaming. The regulations coming into effect, we expect SkyCity to claim significant market share.
What's your assessment of the timeline of the catalyst?
And if we can look at that, the catalyst, the biggest part is that the market doesn't like uncertainty. So MCP will be implemented in July 2025, which is very close. The NZICC will be opening in the next 7 to 8 months. And once the foot traffic and tourism numbers and data come in, this again takes away the uncertainty element. And the last one is online gaming regulations, where we'll get clarity in the next 7 to 10 months, which is where the online casino will be given out licenses, and we'll get more clarity on how this process will work in terms of SkyCity securing one of these. This is really taking away the uncertainty element. And as we've seen in the last week, the market really hates the uncertainty element of what will happen with SkyCity. As we get clarity, SkyCity is poised for growth.
Great. Thank you. Can you tell us something about the board composition and the board governance?
Yeah, totally. So looking at the board of directors, the main thing I want to turn your attention to here is the tenure. So like I said, SkyCity's had some past indiscretions, but all of these were historical. And the last two to 3 years have kind of come to the forefront. So we've got really low tenure on the board, and these are new people who were not kind of alleged to be involved in what's happened in the past. Areas of expertise, as I mentioned in the presentation, are great. They've got a great coverage of governance, gaming, technology, risk management, and legal. And they've got a really strong board of directors. Another really important thing for kind of the corporate oversight as well is their revamped C-suite. So they've got a new CEO, CFO, and Chief Risk Officer. The CEO, Jason Warbridge, is a gaming industry veteran with 20 years of experience, not just in land-based casinos, but in online gaming as well. Background in consulting at Ernst & Young, and he's got that disciplined pedigree. He used to be an officer at the New Zealand Defence Force. And then, of course, their remuneration is tied to these strategies. Obviously, there's a financial aspect, but it's also tied to things like host responsibility, online gaming strategy, AML. So they're just continuing to position themselves as a responsible operator in the space.
Thank you.
Thank you.
I have one more question, if you'll entertain me. It's a follow-on question to what you answered to Judge Steve. You incorporated a 70% probability adjusted discount on SkyCity's online gambling valuation because of the licensing uncertainty, right? Now, how sensitive is your sum of the parts valuation to a 10% change in that assumption? Do you have the numbers?
Okay, if I can go to the sum of the parts on online, this is not really a big part of how this would change a valuation thesis. And if we can go back to the sum of the parts main slide deck. The valuation that is put on SkyCity is 279. If there's a change in expected value of 10%, it would maybe put it off by $20 to $50 million. This is not going to change our scenario. And if I can go back to the appendix slides on what has happened in the past, regulatory action and the second mover advantage that SkyCity has. We've seen this challenge back in Australia with the Crown Resorts, where they were paid a penalty of $450 million, the third largest in the country. The strategy that they employed is similar to what SkyCity has done, with the governance overhaul, stronger regulatory framework, and strategic investment with a cash infusion. And the outcomes that it received was reinstatement of their license, investments, and the biggest part is a commendation that they received from the regulators. So our biggest point is that we're conservative with our estimates of SkyCity not getting this license, but SkyCity has done the exact same thing. A new board with small tenure, new CEO, CFO, and a chief risk officer. They've ended ties with junket operators back in 2020, and MCP has been implemented without any force or regulators stepping into this. And SkyCity has been really proactive. And the last part is having $320 million of a buffer from the debt investment at debt market, which is really strengthening how SkyCity has this buffer built into this. We are being really conservative with our estimates, mainly in terms of the risk that SkyCity faces. As we've seen, this industry is not inherent for having these kind of issues, but SkyCity will fare well as we extrapolate data from Australia.
All right, thanks.
Judges, if there are no further questions, we can end the Q&A. Okay. Thank you, University of Auckland.
Thank you.
At this time, the judges will take a few moments before the next university is brought in. Welcome, University of Finance and Economics. Please launch your presentation and make sure everything is working properly.
Holding the largest capitalization with unmatched market presence, Hanbang Joint Stock Company presents a unique investment opportunity. Greetings, we're from the University of Finance and Economics in Mongolia, and we're initiating a buy recommendation with a target price of 1,558 Mongolian Turkics, a 20% upside from last close. Our recommendation is predicated on 3 thesis points. First, Han is primed to capture the most economic and industry surge. Second, Han will sustain its growth with industry-leading resilience. And lastly, Han maximizes shareholder returns with superior profitability. Today, Hanbang is Mongolia's foremost commercial bank, serving over 82% of the population with the most extensive branch network, making it the only bank with full access to half the population that live in rural areas. As the largest market shareholder, Han dominates the retail segment, deriving over 48% of its income from retail banking. And Following very strong performance in 2024, its share price has been climbing at a steady rate. Han's recent IPO, the largest in Mongolian stock exchange history, saw 14% of its shares now being publicly traded. Han is poised to enter foreign markets, boosting its liquidity, access to foreign capital, and investors, since a 20% ownership cap was introduced to reduce concentration, with its largest shareholder, the Japanese securities company HS Holdings, likely to facilitate this move.
Our first point is that Han is primed to capture the most of economic and industry growth. Mongolia's largest export is minerals, supplying half of China's coke and coal imports, and production is expected to rise, driven by mega projects, including a coal refinery and a new cross-border railway. But declining Chinese steel production and coal prices pose risks. However, rising copper and gold prices, accounting for 20 and 80% of total exports, are expected to offset this impact. Livestock losses from extreme weather slowed economic growth in 2024, but normal winter conditions are driving a GDP rebound for this year. Factoring in the circumstances, Mongolia's economic growth is projected to outpace that of emerging and developing Asian economies, and Han's interest income surged alongside a strong expansion, likely to continue in the coming years. Meanwhile, its expanded net interest margin is expected to remain at this high level as the central bank raised the policy rate back after recent cuts. Following this development, business loans have been increasing due to economic expansion, while strong consumer loan growth has been fueled by rising real rates and government expenditure. Amid this high loan growth, the required reserve ratio was raised, which will lead to a funding deficit for banks, but Han's excess reserves provides an edge. Han holds 50% of individuals' current accounts in the industry, indicating relative stability and cheap funds to issue loans in the short term. While industry loan growth peaked in 2024, Han's loan growth is projected to accelerate further in 2025.
Han Bank is set to maintain its unrivaled leadership in the retail banking segment, attract foreign investment, and leverage effective risk management to ensure long-term sustained growth. Around 97% of Mongolia's adult population uses digital banking products daily, surpassing most countries in the region. At the same time, Han Bank stands out as the only retail-focused bank, meeting 96% of mobile banking needs for customers in remote areas and processes around 74% of total online transactions, which no other bank rivals. Now, the bank is focusing more on customer experience through digital innovations, such as beginning the conversion of branches into tetherless digital funds, doubling online loan volumes, and increasing online transactions with new payment solutions in just 2 years. All things considered, Han Bank's retail market leadership is expected to endure in the foreseeable future. Mongolia has been recognized for its advanced sustainable finance frameworks. Meanwhile, Han is at the forefront, holding 53% of green loan and 51% of SME loan market share. This provides an advantage in attracting international investment, which would foster the development of green loans and SME financing, creating opportunities to further expand its business loan portfolio in line with its midterm strategic goals. Additionally, Han has a risk-averse approach with a strong risk absorption capacity through a high expected credit loss allowance and more than sufficient capital adequacy. This allows Han to have long-term sustained growth, even with the anticipated NPL rise in the banking industry as loan volumes surge and overall risk increases.
Han leads in financial performance and maximizes shareholder returns. Han's net interest margin has consistently outperformed its peers and is expected to remain the highest at nearly 7% in the coming years. Han's dominance in consumer loans, with rates 2.6% higher than business loans, remains a key contributor to its superior margins. Exceeding 90% of its loan-to-stable funding ratio shows effective fund optimization to meet rising credit demand. Comprising 90% of its total income, Han's fee-based income makes up a stable 86% of its non-interest income, making it more reliable than the competitors and reducing interest rate risks. Also, this income exceeds the total of its peers combined, and we estimate this leadership will continue based on increased transaction volumes. Han's ROE has consistently ranked at the top, caused by higher net profit margin and leverage. The bank is expected to maintain its high ROE as it was 10% higher than the industry's average in recent years. Meanwhile, Hans Tita has been declining, now below the industry's average, and is expected to continue downward in the long term due to investment in digitalization. Additionally, Hang is the highest dividend yield non-state-owned company on the market with a yield of 15%, backed by consistent dividend policy with a 40 to 60% payout ratio and sustained earnings growth. Over time, its dividend yield alone could surpass bond yields on the market, making it attractive to long-term investors.
Hang has achieved ESG leadership in Mongolia's advanced frameworks. Without any official ratings, our team adopted the MSCI's methodology in our ESG evaluation, and we placed the most weight on the environment pillar due to the varying initiatives by the peer group. As a result, Hang received an average rating with a score of 7 out of 10, the highest overall among its peers. As the dominant sustainable finance contributor, Hang holds the largest green loan market share. Furthermore, the central bank has set a target for all banks to increase their green loans to 10% of their total portfolio by 2030. However, Hang aims to meet this deadline as early as 2026 and is ahead of the curve. In the same timeframe, the bank will begin emissions tracking and setting reduction targets with guidance from the PCAF, which would boost its environmental standing in the future. The bank supports women entrepreneurs through tailored loan products and boasts a 73% female workforce, and is notably the only bank with both a female CEO and chairperson, despite the industry's predominantly male executive management. Also, the lowest turnover rate suggests a sound human resources policy, and the bank is one of the leading social responsibility sponsors in the country. Meeting the local requirements of 1/3 board independence and operating with necessary committees, the board comprises 9 highly experienced professionals with an average of 34 years of work experience. With a clean track record, we have faith in the management's commitment to transparent and ethical practices.
With no major ESG concerns or controversies, we decided not to apply any discount in our valuation. And we valued Hang using a blended approach consisting of residual income model, dividend income model, and relative valuation, with RIM best capturing bank's value by incorporating book value and earnings. As a result, we arrived at a target price of 1,558 euros, reflecting a 20% upside. From an intrinsic basis, net profit is forecasted conservatively, considering the expected NIM contraction and integrating Mongolia's current high interest rate and risk premiums. The cost of equity is assumed to be 21% initially and arrives at 14% in the terminal period. Even in a bear case scenario with slower loan growth, partnering contraction, and rising NPLs, we still expect a 7% upside. On a relative basis, Hang is trading below its benchmark on both earnings and book value, despite unmatched competitive standing, strong profitability, and capital. Historically, its share price has not kept up with its fundamental growth, suggesting a compelling case for undervaluation. We recognize 2 key downside risks to our buy recommendation. Firstly, Mongolia's economic and geopolitical uncertainties, along with reduced coal exports due to China's economic slowdown, could dampen loan demand and elevate credit defaults. Secondly, credit risks are expected to rise as individuals' debt burdens increase while business loans expand. However, as a retail-based leader, Hang diversifies credit risk and sustains growth, while its strong risk absorption capacity and low NPL ratio are seen as more than enough to mitigate these risks. Therefore, to reaffirm our buy recommendation, Hang Bank leads Mongolia's banking industry with market-driven expansion, sustained long-term growth, and strong earnings performance. We'd like to thank you for your time and open the floor to questions.
Thank you. Judges, you may now turn on your video. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Sure, let me get started. So I have 2 questions. So number 1, it seems like DCF is not commonly used valuation methodology in banking industry. So want to understand why you use DCF as a main valuation methodology in this case. And second one is you implied a 20% discount to the target price, and it's a it's a blue chip company. So what was the investors thesis, what investor thesis got it wrong? Because 20% is a very significant discount to the target price. And because the target company is a blue chip, it's very unlikely that majority of the investor make a mistake coming up with the market price. So to summarize, two questions. Number one, on the valuation methodology, why use DCF? Second, what's the catalyst? What the investors got it wrong by discount the target price by 20%?
Okay, thank you for the question. I'll take this one. If we go to the appendix number 84, the bank's value is closely tied to the book value, as it is an item on the balance sheet that incorporates regulatory factors while expressing how much value does the bank currently have. And on the other hand, earnings represent how much additional value the bank is creating. Thus, practically, the book value and earnings are widely used when determining the value of banks. And the RIM, the residual income model, is chosen as a core method as it best captures this picture of bank's value, while it is reducing the subjectivity of terminal value, as it is heavily reliant on book value, which makes up around 90% of the total value in residual income model. And during this core model is used to its representative feature of bank's actual cash returns to investors, which incorporates the regulatory factors as the dividends are paid after the bank meets the requirements of the central bank. However, as the bank has insufficient dividend history, it has given 10% weight considering its dividend policy and stable earnings. Now, if you go to the appendix number 88, we try to support our core method residual income model with equity multiples by aligning the structure of two approaches as we try to reflect the investor sentiment and harm being partially value stock, as the IPO was relatively recent, and we give 30% weight to the relative valuation. Thank you. And on the second part, if you go to the appendix map and if we go to appendix number 79, as you can see from here, the cost of equity is calculated using the capital asset pricing model. And since Mongolia does not provide statistically significant data for cost and does not have risk-free securities, we try to acquire it by converting the returns of America, the S&P 500 and Treasury yield, and adjust by inflation rate of the two countries using Fisher's equation. And I think it is notable to say that the cost of equity is in nominal terms. So considering the Mongolia high inflation rate, the cost of equity is reaching 20%. But we expect this inflation rate will converge to that of more developed countries. Thus, it is reaching 14% in the terminal period.
Great,
and
thank you.
To add on that briefly, we also consider the additional risk the Mongolia stock market is carrying, thus incorporating the country risk premium.
Okay, I have a few questions. Let's start with the first one. So have you looked at the off-balance sheet items and off-balance sheet risks, considering it's a bank and it's very important to look at it?
Yeah, we considered it. If we go to the slide number 13, fee income. Yes, as you can see from the first graph in here, our income structure is very traditional, as it can be for banks. The net interest income and fee income makes up the majority of it. The other incomes are the fraction of it. So the net interest income is based on the loans and interest rates. So, and On the other hand, fee income is a very stable income source as we believed. So we see that the one-off items on the balance sheet is not a key contributor to its superior profitability.
Okay. My second question is on the board committees. Now, typically, banking companies have to have a lot of focus on technology and digitization. I don't see any board committee on technology. Is this something common in your part, or your country, or is this kind of something a missing committee there?
Yeah, so I can answer this question. Yes, so the law on banking actually requires these 4 committees to be operating in a bank. So the governance, remuneration, audit, risk, and nomination, human resources. Hambank has just not been able to establish a technology committee, but if we go over to its executive managements, we do have many executive management presidents that are very experienced in technology and banking, digital banking products. So we foresee that the lack of a technology board is not a material risk and is not required by banking law.
Okay, thank you. And my last question, how liquid is the stock? And you mentioned that there will be divestment by some majority shareholders. So how certain is that, and what is the time frame for that?
All right, so I can answer the question about that ownership limit. So the central bank has made an amendment to the law on banking, which dictates that any individual person or jointly owned by persons or entities shall not exceed more than 20% of the total issued shares of the bank. So right now we see that 2 major shareholders exceed this limit. The deadline has been extended many times with restrictions. Currently, it's by end of year 2026, December, that all banks need to comply to this rule. But we foresee that Hambank might manage this by private placement to other foreign strategic partners, or they will relist their shares on international markets, as we heard news about Hambank meeting with other foreign stock exchanges.
Okay, thank you.
So I also have a. Go ahead. Go ahead.
Okay, I just have one question. Slide number 13, where you were talking about thesis number 3. There you spoke about how Khan has a strong fee-based income which surpasses the peers. But I want to understand, to what extent is this sustainable? Have you stress tested fee income projections under, a scenario of maybe increased digital competition or reduced transaction margins? Have you performed a stress test?
I think I can answer this question. If you go to the appendix map, appendix C, fees, commission income number 64. Appendix C, fees and commission income. The appendix D. We have researched online market transaction of last 4 years, and mostly over 73% of the internet banking transaction goes through Hambank, and reflecting quite competitive advantage in the market. And most transactions that are around 47% are done through the Hans plastic part, but this share is declining as mobile and internet banking grow. Also, if we move to the next slide, this strong fee income has a volume of 20% of its total income, and exceeded the sum of the other top 4 banks from the 2022 and 2023, which illustrates how this fee income is strong.
And if I may quickly add on, as we mentioned before in our overview, Hambank already serves 82% of the population, and we do not expect this penetration to waver in the long term as of now.
If you allow me to ask a final question, sorry, go ahead.
Yes, I would like to ask
Gabriel,
a question. No, that's fine. I mean, I would like to ask a question going back to the free flow that the company has currently. Is it anywhere embedded in your valuation, the fact that the company has a very thin free float?
Yeah, I could answer this question. If we go to the appendix number 95, I should say that the liquidity risk premium concerning the low free float is included in our cost of equity calculation, and I'm here to explain it more comprehensively. And we apply the 2% risk premium to our cost of equity concerning the liquidity related to low free float and Mongolia's stock market liquidity and features. Moving to the next slide. The major banks in Mongolia have recently conducted their IPO, making their free float low currently, with Han having the highest free float at the moment. And we expect, due to the ownership concentration, as you mentioned in our overview slides, a 20% cap is posed for them, pushing them to enter foreign stock exchange, because the bank's market cap is too large for such an amendment for Mongolian stock exchange. So it is highly likely that Han's free float will increase in the foreseeable future. About the impact of this divestment of large shareholders, we see that the increased liquidity will make the intrinsic value more achievable, since Han is partially a value stock, which the market currently is not priced in.
Yeah, just want to clarify.
Sorry. Yeah, go ahead.
Oh, sorry. Just want
Go
to
ahead,
clarify. So what's your final verdict? So the valuation upside from liquidity is a liquidity play or fundamental play? It's because it's very strong fundamental and everyone knows it. It seems like a market consensus. So upside percent, 20% upside is from liquidity, increased liquidity, or fundamentals not really discovered by investors.
To answer that question, I think it is notable to say that Han is a value stock as much as it is a growth stock. So we see that they both will contribute to the 20% upside in the coming years.
Okay.
What is the contribution of trade in the revenue and the profit margins of the bank? And how do you see reciprocal tariffs between China and US going to impact that?
If you go to the appendix 125, in our sensitivity analysis bear case, if Mongolia's GDP growth drops to 4%, and we estimate that due to the financial US and China trade war and the recent tariffs imposed by the US, we estimate that Han Bank's loan portfolio growth would decline by 9%, and primarily due to reduced credit demand across sectors. As a result, our valuation for the bank would
That is time. Thank you, University of Finance and Economics. The judges will now take a few moments before the next university is brought in.
Thank you.
Thank you. Thank you very much.
Welcome, University of Sydney. Please launch your presentation and make sure everything is working properly.
Origin, Australia's leading integrated energy company, is powering through market volatility as a structurally resilient business with a clear path ahead to light up shareholder returns. We issue a buy recommendation with a 12-month price target of $11.84 at 18.2% premium to the 1-month VWAP.
Origin is Australia's energy provider of choice with a diversified 3-segment model consisting of 1, the internal energy market operations across electricity and natural gas, 2, APLNG, an upstream LNG producer, and 3, Octopus, a UK-based software-driven electricity retailer. Operational and geographic diversification is the power source behind Origin's story, with an expansive generation fleet that delivers 7.8 gigawatts of energy to the homes of 4.7 million customers today. This diversification has brought advantages in the form of strategic fleet distribution and flexible output capacity, which have powered Origin to the top as the leading energy giant of Australia. And over the long term, we see Origin's lead will endure, with growing future demand driven by tech advancements, including energy-intensive data centers and the movement to electrification and renewable energy.
This increased demand, however, is set to drive further volatility in an already volatile Australian energy market. There is a forecast deficit of 17 gigawatts in the Australian energy market, exacerbated by the closure of 5 gigawatts of coal power plants. This creates an immediate brownout risk, yet Origin is structurally well placed to deal with this, given one, their pipeline of renewable assets being well timed relative to peers to deal with this risk, and two, their lower cost basis indicating that they are better prepared for future cost volatility. Despite such structural advantages, however, Origin has fallen to trade at a multiple below the industry median, and hence, we issue a buy recommendation, underpinned by 1, Origin's flexibility from the diverse energy portfolio, 2, cash flow stability from APLNG, and 3, growth opportunities energized by Kraken and Octopus, enabling Origin to power through an era of global volatility.
The flexibility of Origin's energy supply portfolio and capex-light focus will offer insulation against the volatile market. Australia's energy market is now the most volatile globally, with forecast renewable shortfall and understated brownout risks. From these extremities, the market has mispriced Origin's superior positioning, driven by 1, its industry-leading firming capacity with gas peaking plants and an unrivaled virtual power plant, and 2, the timing alignment of batteries coming online to its Eraring coal plant closure, differentiating Origin from its duopolistic rival AGL, whose pipeline is mainly yet to be approved. This portfolio advantage will lead to reduced expensive spot market reliance and capture mid-transition arbitrage during peak demand. We forecast these advantages to increase TAM share to 22%, boosting top-line EM growth and a 5% uplift in value. Besides output capacity, flexibility is also recognized in the balance sheet from a disciplined capital-light focus. Across recent battery developments, Origin's offtake deals with infrastructure partners achieves a capital-light strategy due to lower capex constraints. This has led to Origin's proven ability to beat capex consensus by on average 18%. Representing unwarranted grouping to capital-intensive peers. With a capex to sales of 3.2%, there is material mispricing of long-term efficiencies. Shining over peers, we forecast competitive PPAs to drive returns and a 2% ROIC uplift.
Second, APLNG is energized by cash flow stability from APLNG, allowing them to power through global uncertainty. First, Origin has long-term fixed contracts for the sale of LNG from APLNG, which is set to secure stable revenue through the forecast horizon. With 95.6% of Origin's annual production structured into take-or-pay contracts with Sinopec and Kansai, this is set to guarantee over $25 billion in revenue over the forecast horizon, supported by 1, minimal counterparty risk, given Sinopec and Kansai are both state-owned, and number 2, Origin's market-leading reserves position on the East Coast, which not only allows them to fulfill this contract, but to dominate the gas market moving forward. Furthermore, supply-demand imbalances both domestically and internationally are set to drive strong LNG revenue for Origin. Domestically, demand for LNG is set to exceed supply as soon as FY29, yet this will drive up Origin's domestic revenue by as much as 5.9% as domestic prices near international netback prices, whilst internationally, Origin is set to be the beneficiary of increasing Southeast Asian demand from coal to gas switching, but relevantly declining production from key LNG powerhouses traditionally like Indonesia. With APLNG's favorable positioning in this region, this is set to deliver over $9 billion in free cash flow, which Origin can utilize to stabilize in an era of volatility.
Third, Origin's 22.7% stake in Octopus contributes 25% to its valuation, driven by Octopus's dominant position in the UK market and its ongoing international expansion. Origin also benefits from strategic integration with Octopus's successful traits, which enhances its competitive positioning in a volatile market. In 1, delivering exceptional customer service as seen in its NPS margin. 2, harnessing network effects. And 3, optimizing cost efficiency. This growth opportunity within a structurally mature industry remains underappreciated, resulting in a 1.9% lift in Origin's market share. Next, Origin is cracking down on costs. Origin's proprietary ownership of Kraken technology is unmatched and is expected to reduce one, network costs through grid optimization, which is key given the energy market's volatility, and two, cost to serve via automation. We forecast that these costs will fall below consensus as Kraken was only recently integrated after management delays. As indicated by our proprietary survey, these lower costs enable Origin to price more competitively, which is the main factor in reducing churn and replicating Octopus's customer stickiness model.
Origin continues to supercharge its network with a powerful triple bottom line. Origin has become a power player in the industry by illuminating a transparent path to a sustainable future. Origin's latest actions have shown transparency behind its plan to switch from carbon-based energy to renewables, with the confirmed closure of their Araring coal plant, along with $1.5 billion worth of investments in battery, solar, and wind projects, altogether yielding towards its confidence towards its 2050 goal for a net zero emissions profile. We foresee that this action plan will spark positive MSCI and Sustainalytics re-ratings that will bolster its relative ESG position, as we see that future ESG scores of utility companies are expected to prioritize renewable production. Flexibility in Origin's operations has been reflected into its service becoming reliable and affordable. With the rising adoption of Origin's Power On program, Origin's customer network is set to be insulated from the cost of living crisis inflicted by recent global economic tariff activity, with customer happiness index growing at 14%, which further supports our MSCI re-rating. Origin's plans continue to be executed by an astute governance team, having the relatively highest level of diversity and experience for the last 3 years. With a powerful remuneration system pivoted around shareholder value, there's extreme conviction that Origin's governance team will supercharge their social mandate and ensure substantial improvement to the Net Promoter Score.
The origin of our buy recommendation is a robust, multifaceted valuation. Our relative valuation utilized enterprise value multiples to value each of Origin's 3 segments to separate suitable peer sets, which were added together to arrive at a target price of $11.44, implying an EV to EBIT multiple of 13x. With Origin currently trading at only 11.2 times EBIT, we expect Origin's strong competitive positioning to drive value uplift and re-rate towards peer multiples. Our intrinsic valuation reinforces our belief that Origin should trade at and above peers with an implied price of $12.01. This is derived from a granular, bottoms-up, discounted cash flow model where we forecasted all key idiosyncratic revenue and cost drivers across energy markets, APLNG, and Octopus. Together, we used a blended valuation, weighting intrinsic 70% and relative 30% to arrive at an implied share price of $11.84. We believe this price to be robust. A Monte Carlo simulation model indicates our buy recommendation holds true in 88% of the 100,000 simulated cases. We even utilized a reverse DCF model, which indicates that historical free cash flow growth outpaces market implied forward growth by 2 to 3 times, demonstrating the market's underestimation of Origin's proven ability to grow free cash flow.
1 minute.
However, this era of volatility presents 5 risks, 2 of which we consider significant. Notably, a shifting electricity supply mix underpins Origin's future reliance on bought generation, with these costs vulnerable to exogenous forces. However, Origin's management is expanding supply from favorably priced PPAs from its development pipeline to mitigate cost pressures. Furthermore, the government subsidization scheme for 9 gigawatts of clean firming capacity development threatens the competitive edge of Origin's own firming capacity, putting downward pressure on peak wholesale prices. However, with a proposal to include gas in this scheme, Origin can benefit from the scheme and reduce its costs.
Origin is unrivaled in the volatile energy transition through 1, its flexible energy portfolio bolstered by 2, APLNG cash flow stability, and 3, leveraging unique Octopus growth. Now, a brighter path ahead has been sparked, and it's only up from here. This is just the Origin.
Thank you. Judges, you may now turn on your video. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Well, I'm
gonna go ahead.
Oh, good. All right, I just have a couple of questions. Your Monte Carlo simulation suggests that 88%, was that number right? 88% of scenarios support a buy recommendation. Yeah. Now, can you elaborate just 3 variables that have the greatest impact on the distribution of your outcomes, and I would also like to understand, how you selected the probability ranges.
Sure. If I can take you to F22, this is our Monte Carlo simulation on our DCF model. We looked at key inputs and drivers of value in Origin's business model. Firstly, electricity revenue. Secondly, Origin's market share in the electricity market. And we also looked at the growth of natural gas, given APLNG is a significant driver of free cash flow. Now, across the board, we use a standard deviation that was similar to historical trends, and we think this is a great proxy for the future volatility. And so on top of that, we also looked at depreciation, APLNG, total production volume. But the three key variables we believe, electricity revenue, market share, and natural gas business volumes.
I'm happy to answer. Oh, sorry. I'm happy to answer the second part of that question regarding how we selected those variables. To select those variables, we conducted a broad sensitivity analysis. We looked at what inputs had the greatest impact upon our buy recommendation, and therefore utilized that to suggest which of these variables should be utilized.
Got it. And when you talk about, in your thesis, I think you spoke about Origin's CapEx light approach, and I think that was a big part of why one should invest, and also the reliance on PPAs. Now, how do you assess the long-term risks of reduced asset control, especially given the fact that volatility in the national energy market is continuously growing?
So if I could please take you to slide B7. So we see that with Origin's capital light approach, they've engaged in recent offtake agreements where they partner with infrastructure partners. And through this, Origin maintains the initial ownership control benefit of being able to de-risk development and secure key geographic locations that allows them to have value accretive battery projects at these strategic locations. And through the partnership, then they're able to maintain their flexibility and maintain their future pipeline of projects. So if I could please take you to also slide B5. We see that Origin has 4 to 5 gigawatts of planned projects by 2030 to meet their retail demand, as well as 1.5 gigawatts of committed battery projects. And with this, we see the Yanko Delta Farm, for example, being 1.5 gigawatts, a key project that with approval received and expected by 2027. And we see that their upcoming projects are well aligned to their Eraring coal plant closure, and that this is favorable for them going forward.
And if I could just add quickly to my colleague's response, we actually sensitized that reliance on PPAs and market contracts, given that is a significant part of Origin's strategy into the future. And if you look at the graph in the middle, you can see that our forecast for market contracts beyond FY24 has it increasing from $40 per megawatt hour up to $80 on a terminal basis. And we think this is a very conservative estimate. That's double last year's market rate. And so even if we do sensitize the terminal market contract unit cost on the right-hand side in our sensitivity table, if our terminal unit cost increases by $20 per megawatt hour, our buy recommendation still holds. So we baked in a margin of safety. And on top of that, our sensitivity shows that our buy recommendation will hold.
Fantastic. Thanks, team. Gabriela, go ahead.
Yeah, my question, thank you. My question revolves around the market approach. Have you considered like the installed capacity that the company has, like when doing the peer analysis?
Sorry, could we clarify by install capacity, that's the capacity that Origin owns on their balance sheet?
Correct. No,
Sure.
no. In terms of gigawatts that they produce.
Sure. If I can take you to F5, electricity supply. So on the right-hand side, we see our forecast for the electricity supply for Origin's future electricity business. Now you can see in gray the Eraring plant produces a significant amount of Origin's current supply. However, with Eraring's coal as a coal plant closing in FY27, we have this conservatively decreasing as a proportion of supply to zero in FY29. And with the increase in batteries from Origin's strong battery and renewable pipeline, we see that increasing into FY27 as they prepare for the closure, and then market contracts making up the shortfall.
In terms of their peers, I'd be happy to take you towards slides A9 and A10, where we did consider their peers explicitly as well and consider what difference in terms of their asset looks like. AGL is Origin's greatest competitor in the eastern seaboard, but AGL is hindered by what we view as a far more coal-based asset portfolio, which might be valuable in the short term because coal might be cheaper, but it means that the capex requirements become infinitely more expensive the more time passes, and thus is far more favorable to Origin, particularly given that volatility is about to come. Origin has at least gone ahead of the competitors, and this is something we've factored in.
Can you share something on the sensitivity analysis that you have done in some of the slides here?
I'm
Sure,
happy to. Oh, yeah. Kevin, go ahead.
I'd be happy to talk about sensitivity analysis. We might split this question up between us since there are 3 separate divisions to Origin, so we might look at each of the separate divisions. I'll look at the oil side. So if you look at slide I1, what we can see is commodity indices. Since Origin's LNG contracts are hedged against the price of oil, they have a slope of approximately 14%, which means they're priced at 14% of the crude oil. We checked what crude oil differences could have upon Origin's share price. And whilst we have been somewhat conservative in our estimate, although we have acknowledged OPEC Plus, who have increased their production updates, and also Trump's tariffs, which will decline demand from America, which is the second largest demand of LNG globally, we still believe that even if it falls to a $60 or a $55 mark, our buy recommendation still holds, and this is further supported by Origin's hedging positions. So even if crude oil falls, if we go to slide I7, what we observe is that Origin's hedges are all in the money in terms of Forex and also JCC and JKM, which is the type of Asia-specific LNG contract utilized to measure against oil prices. So that is why we believe they're well placed for this risk.
And just to add on, Marcus, if we could go back to the appendix slide and go to competitive intensity in I3, 143, we've sensitized 2 key factors. Firstly, market share, because we believe that Origin's market share going forward is quite important. That is significantly driven by the cost that they charge their customers. And we can still see that it holds a buy recommendation in the majority of circumstances. And secondly, on to Thesis 3, we noted that Kraken is expected to reduce network costs. We also sensitized network costs as a percentage of revenue and found that even if Kraken doesn't perform as significantly as it has with its peers in Octopus in the UK, we still expect that some fall in network costs would still yield a buy recommendation. So we've taken a very conservative approach in all of our sensitivity analysis.
I got one question. So first of all, excellent work. So if I have to ask one question, so what's the kind of the edge case? So low probability case can dismantle all the investment thesis of your presentation, because the presentation itself is very comprehensive already.
I'm happy to talk about this. If we go to slide F24, we've performed a scenario analysis as to what it would take to take a re-rating for Origin to a negative price. The first is on its energy markets division. That would require a decline in electricity revenue per megawatt hour. This could be sparked by government reforms, but given the most recent reforms as of a week ago in Australia as to the maximum price electricity providers can charge, we don't think that this is likely to happen. The tariff, which is the maximum ceiling, was increased by 8%, indicating that Origin is well placed to deal with inflationary risks. The second key factor which might impact is the success of Octopus, not only in its growth, but also in its ability to serve customers. That said, if Origin is unable to reach the cost to serve reductions for Origin, this keeps Origin's cost of goods sold relatively high, which means that their margin weakens and this will negatively impact the price. The final is what we just discussed on LNG and their oil contracts. If OPEC continues to increase beyond market consensus their oil production, given pressure from its member countries to do so, but also oil demand falls because of global instability, we think that this could have a negative impact upon the LNG contracts that Origin has. But given that there is a repricing event which we believe has happened positively, we believe that Origin will be okay from this bear case scenario.
Judges, if there are no further questions, we can go ahead and end the Q&A. Okay. Thank you, University of Sydney.
Thank you.
All 4 teams have now presented. At this time, the judges will begin deliberating. Please make sure to rejoin the Zoom session in about 30 minutes to hear which teams are advancing.
Welcome back, everyone, and sincere congratulations. We've heard some remarkable presentations today. And the level of thought, attention to detail, insightful analysis, teamwork, and presentation skills were just great. You have all impressed us way more than we can say, and the judges as well. We want to encourage you to use this experience, put it on your CV, put it on your resume, talk about it in job interviews, be ready to talk about what you learned, what went well, what things you would do differently. Any sort of thoughtful reflection is a sure way to impress an interviewer. Each team today has already enjoyed significant success in this competition, but as we know, 2 will be proceeding to the Research Challenge Global Final. So the judges have scored all the teams and the results are in. The 2 teams that will be representing the Asia Pacific region at the Global Final in Chicago on the 5th of May are going to be the University of Hong Kong and University of Sydney. So thank you again to all the teams and to the judges for your hard work and dedication. Congratulations to the 2 winning teams advancing to the global final. I will be in contact with you shortly with some details regarding the travel and everything. But again, well done to everyone. And with that, we are done.